Hello, welcome back. A requested company, XPeng, is one that we're going to be examining today. This is an EV company, it's a Chinese company. And of course, you can understand that these kinds of companies are really discussed these days. They are very trendy, mainly because of Tesla. Tesla has caused an influx in these kinds of companies, pretty much elevating their valuations to the moon. But do they actually deserve it, is the question. And in this video, we are going to examine the financials of this company. And I kind of want to tell you a few things and sort of like raise the alarm in these kinds of companies, because you have to be super careful. Now, typically speaking, when we're talking about car companies, they tend to be super boring. I just want to use our tool here and kind of show you Ford, which is F. F is actually the Ford Motor Company. Ford is a fantastic company, like it's a huge company, of course, a very well-known company. If you take a look at its 5 years chart, you will see that, it has been sitting at sort of like in a range. It hasn't been moving too much. And, this is not a company that like moves tremendously. And it's not a company that skyrockets, right? And again, if you take a look, if you take it to the max, which starts from like 1970s, it still used to be $2, and 2009 it was in $2 again. So as you can understand, these companies have a lot of ups and downs, and they're not really the typical companies that tend to do well. And take a look at Ford. Like Ford has a PE of 5, a price to free cash flow of 5. It's a cheap company, or it looks like it's a cheap company, right? But it's not really growing. And of course, there is something to be said there. It's not a company that's growing, but it's cheap. Now, let's go back to XPeng. What about this one? This is pretty much the new diamond, right? It's a new company. It's a company that is selling vehicles, of course. If you take it to its website, you will see in its investors relations page, very nice cars over here, nicely looking cars, especially this one, I guess, sort of like the Chinese Lamborghini or something of that sort. But if you see over here the vehicle delivery results for November 2022, they actually sold 5,800 vehicles in November, and about 110,000 vehicles cumulatively in the first 11 months of 2022. So they do sell cars, and I think these numbers are very similar to NIO, really, and very far from a company like Tesla, of course. But still, they are pretty fair numbers, pretty nice numbers. Now, the thing is, and this is very important to understand, these kind of companies, like companies that develop cars in this case, they are very cash hungry. They require a lot of capital in order to work, and typically they take a lot of loans as well. So they are cash hungry companies. Imagine the amount of money that you need to spend in order to be producing these kinds of vehicles, right? And the thing is, they tend to also have low margins, because this is a super competitive industry here. And so for a long time, they probably have to lose money, not even make money. And this is what Tesla was doing. The big problem here is that as these companies are losing money, and while they're losing money, investors keep flocking in because of this craze with Tesla. And look what happened with this company in this chart. It used to be 64, for instance, over here, if I take a random spot, and its 1 year high was 51. It's currently sitting at 11, so imagine if you bought near this craze. You bought a company that was overpriced, like seriously overpriced, at $70, $60 a year ago, but that's just a year ago. Today it's sitting at $11, and it's still looking expensive. Why is it looking expensive? Why? Take a look at the PE ratio. It's in negative territory. It used to be more negative, which means that the net income compared to how much money they were losing was even worse. But since the stock price is actually going lower, the net income is a little bit better, again, compared to the stock price. And the same thing with the price to free cash flow. Also is negative, though it used to be much worse. Remember, if you bought over here or here. And the company, being a new company, is a company that is issuing a ton of shares. Because if you're not making money as a company, what are you going to do? You have two sources to make some money and use it for your cash-hungry business. You either issue more shares, and you sell them to shareholders who are flocking in because of the craze, because of the trend. Or the other way is to get debt. But if you get debt, then you have to pay interest, and it's much more expensive than just issuing shares and getting money for free. Regardless of the situation, it's a dire situation for the investors, because both cases are bad unless the company very quickly manages to turn some profit. Now, in terms of the total liability, it's also negative compared to the free cash flow because, again, this is going to be negative free cash flow. It's a negative value over here. The nice thing about this company is it's growing tremendously, and it's growing tremendously. And you will see this insane growth values because they are starting near zero, as you'll see. So you would expect that it's it shouldn't take you by surprise that it's that high. But the net income, oof, it's horrible, and it's going down and down and down and down. Again, cash hungry, low margins, they don't turn profit. And the same thing with the free cash flow, again, going into negative territory. With the total equity growth is the only thing that goes up in these cases. Why? Because the company is issuing shares. And when you issue shares, what do you make? Money. And so when you make money, you have more assets. More assets, same liabilities, means more equity. That's how you grow your equity. That's how these companies grow their equity, because they cannot grow it from retained earnings because they don't have any right now. So be super careful over here. The good thing, the company doesn't have a lot of debt compared to its equity yet. They have been mostly getting their equity from shareholders, but not by financing, not by getting extra debt for now, at least. But at some point, if they continue to not make profit, at some point it has to give. They will have to get some debt. So this is important, and this is why I love this kind of metrics here that we have in our tool, because it tells me a story immediately just by looking at these numbers here and know pretty much what the company is doing financially. And of course, it's always important to take a closer look, and we will do it with the financial statements. But these kinds of charts over here really tell me a story of what has been happening with the company in the past few years. Now, the income statements. Again, we don't have too many years because it's a new IPO, pretty much a new company. You will see that they have been growing the revenue. Again, remember, they started from something that's very close to zero before they became an IPO, pretty much. And you will see here that the net income that the company generates is negative, approaching 1 billion. And that's a bad sign over here, the fact that it's getting more and more negative. And another thing that I like to see in these situations is the EBITDA. Kind of tells me some story a little bit. Remember, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's pretty much a fancy way to say that I'm excluding a lot of the expenses in order to see what the company generates in terms of core profit. Not profit, core earnings, I should say, because it's not really profit. We are excluding a lot of expenses. But what are we making in terms of core operating income, pretty much, is what we're saying here. And the answer is nothing. We're still losing money, even as EBITDA is accounted for. And if we take it to net income, the story is even worse, because then we account for more expenses, and it gets to a worse situation. Now, in terms of the balance sheet, as you would expect, what would you see here? I mean, if you have been watching my videos, you know the drill. If you take it to additional paid-in capital, you will see the insane amount of billions accounted for because of the issued stock. Because when you issue stock, you get additional paid-in capital. This is how you get your equity line over here, with extra pretty much assets coming in from investors that bought your newly issued shares back in 2020, as you'll see here in 2021. And in terms of total equity, this has been increasing because of this additional paid-in capital here, which, remember, it's about 16 billion, yet because of the liabilities, we are sitting at 6 billion, so we're burning through the capital very quickly here, and at some point 2 years ago, we're negative. So it's not looking great, guys, right? If you examine the story here, it's not looking that great. And if you take it to the free cash flow, you will see again that we are sitting at almost minus a billion over here. And in terms of the cash that the company has at hand, it's sitting at $1.8 billion. But again, they seem to be burning quite significantly over here, as you'll see. And the operating activities cash flow, again, negative, even after we account for the non-cash expenses over here, stock-based compensation, depreciation, amortization, changes in working capital, and all these things. Still, we're in negative territory. Okay. Now, we do know that this company is super risky if we want to invest potentially. It's a company that's not earning profit. We have established that. But maybe it's too cheap. Maybe it's still too cheap, and maybe it's an opportunity to just grab a little bit and see how it plays out. We will use our tool here to decide whether that's the case. Now, obviously, the revenue growth has been insane because the company started as sort of like a private company and then moved to an IPO. And we will go with something that makes more sense, but still high, 20, 30, and 40, still very high. We assume that the company will continue growing at a tremendous pace. It's a new company. It could do that. It's not out of the question. But in terms of the net income margins, what are you going to do is the question. Because take a look at this. It's negative. Now it's getting a little bit better, but still very negative. And if the company never turns profit, it's not worth anything. Don't just listen to like YouTubers or any other sources that tell you that this company could make some money through the years and things of that sort, like in a decade or so. If the company is not making money, it's not earning profit today, it's not really worth anything. And what you are doing is speculating, because a lot of companies who are not turning profit today, they will never turn profit. So some will, yes, and some will become successes. But you are taking an enormous risk by going with these kinds of companies that are not turning profit. This doesn't mean that it will continue growing at a tremendous pace. It could. But the thing is, what is it worth today is what we're asking. Because, would you buy something today that is actually worth $1,000? Would you spend $100,000 on it? Because that's essentially what a lot of people were doing when they were buying this at $50, at $60, at $40, and now it's 11, and it's still expensive, obviously. And the net income margin, we still have to use something that is at least marginally positive, because again, if we don't do that, it doesn't make sense to buy it today at all. And the free cash flow margin, we're gonna use the typical thing, 80, 90, and 100. The company, again, it's not positive in terms of free cash flow, negative free cash flow, so we cannot really use any values, but we'll use something that is sort of like a standard 80, 90, and 100%, which is about 80% of the net income margin, this one, 90% of this one, and 100% of this one. So that will be 5% over here when compared to the revenue. And the annual return, 13%. Let's hit calculate. What are we getting? Yeah, as you would expect, if the company becomes marginally profitable, it's still expensive. And so this is why I basically wouldn't touch this one. And yeah, if there is a trend and if things go back to the exuberance phase, you could see this climbing for sure. But if things progress normally and this gets to its core valuation, this looks like it could go down significantly. And so I wouldn't be surprised if it goes $5, for example. It wouldn't surprise me at all. And in this case, maybe it's just worth it to take a little bit, or take it for a run, and just take it as sort of like a lottery ticket that could potentially do well, with the understanding that it's a risky proposition. But sitting at $11, almost 12 right now, I think it's very expensive, so I wouldn't touch today. But thanks for watching. Tell me what you think about XPeng, or however else you pronounce it, and I'll see you in the next video. Thanks for watching, guys. I'll see you soon. Bye-bye.